Thanks for inviting me. One of the things I really like about conferences such as this is that I get to learn a lot. So I've already learned a lot, and I hope to contribute to that myself. So this is a project titled Natural Disasters, Local Bank Market Share and Economic Recovery. It's joint work with Daniel Hartley at the Chicago Federal Reserve Bank. Here's a picture of Yellowstone flooding in and around Yellowstone about 2 summers ago. This isn't too far from where I now live in Bozeman. The flooding occurred because there was a really great 3-foot late snowstorm that unfortunately I had to miss because I was traveling, but the snow melted very quickly, and the snow melt then went down to the riverbed and was followed by a lot of rain and flooded the Yellowstone River in and outside of Yellowstone National Park. Where I am in Bozeman, about an hour north, it's kind of a setting where you can kind of get a lens into what we're trying to do in this paper. So one of the questions that we're asking is, does regional economic recovery following a disaster, a natural disaster, depend on the type of banks operating in that economy? So here are, if you walk down our beautiful Main Street in Bozeman, Montana, there's lots of boutique shops, nice watering holes, and plenty of great restaurants. You'll also find 4 or 5 bank storefronts. Here are 2 of them. On the left, we have First Security Bank. It's founded in 1919 in Bozeman, Montana. It serves only Gallatin County and is the largest bank in the county by deposit share. So we're going to think about this in sort of our analysis and in the language we use as a very local bank or a locally oriented bank. On the other side of the extreme, we have Wells Fargo. Wells Fargo, as we know, is a very large bank. It operates throughout the country and throughout the world. Our interest in this project and this question was really motivated by an earlier finding in some of Dan and mine work. So this is a picture that, or a kind of a fact that we documented in New Orleans following Hurricane Katrina. I want to sort of use this as the jumping off point of what we do in our current project, so let me explain what you're looking at. So what it shows is new quarterly mortgage originations by local and non-local banks to residents of New Orleans in the areas of the city that were the most flooded from Hurricane Katrina. The vertical dashed line is the timing of Hurricane Katrina. We have quarterly data, so all of those points in the picture are quarters for the 3 years before the hurricane and the flooding and the 3 years afterwards. What we did using information from HMDA, Home Mortgage Disclosure Act, is to follow all banks that were making loans in New Orleans before the hurricane and observe for each bank the share of loans, which would be new mortgages, but also refinancing and home equity lines, so anything home-related credit. All loans made by these banks in New Orleans before Hurricane Katrina, and divide those banks into those that were making a high share of their lending in New Orleans versus a low share. And all we did is cut it sort of at the medium of the distribution of these banks, called them sort of local and non-local banks. And this is the picture that we got. So before Hurricane Katrina, about 2/3 of the new loans, so the market was really dominated by what we're calling these non-local lenders. After Hurricane Katrina, we see a different picture. A lot of the lending by these non-local lenders, the same lenders as before, we can track them with the IDs. These lenders largely left the market, and it was what we're calling the local lenders. Pretty much after a few quarters, we're back up to lending at similar levels as to before the hurricane. So this was sort of surprising to us, but it is just one event, sort of one sort of data point. So the jumping off point of our current research is really to try to expand the lens to look at many more events throughout the country and at different time periods. So as we know, access to credit is really important. This is sometimes overlooked in some of the academic work in the field that I do, which often focuses on, say, federal disaster assistance or maybe insurance as other mechanisms to sort of protect people following these types of events. But just lending, having credit from the private sector is a really important means for individuals to sort of smooth these events that happen to them. At the same time, we might think that the higher level of loans and credits that's going to a particular region could impact both sort of like near-term recovery in that area, that is the economic region itself, and sort of longer-term trends in economic recovery. And there's several strands of literature in economics and finance that show different reasons why this could be the case. We have 2 research questions that we analyze in this project. So first, do locations with a higher share of local banking at a time of a natural disaster have greater total lending post-disaster? Second, Do any differences in post-disaster lending at the time of a disaster attributable to the role of local banks affect regional redevelopment and recovery? So we really want to try to make that link between where is more credit provided and does that increase or decrease in credit sort of have a carry-on effect to the local economy. I'm not sure I'm going to get to say everything I'd like to tell you today, so I want to provide a little bit of an overview and sort of a summary before I get into some of the details. So economic theory provides contradictory predictions on how a greater concentration of non-local banking affects overall lending to a disaster region. We build a new US county-by-year database to test our two research questions. I should add, one reason we're kind of departing on this research agenda is that there's sort of conflicting theoretical predictions, and in the literature itself, to date, there's sort of conflicting findings as to whether or not having a higher or lower sort of institutional development of more locally focused banks sort of has an impact on lending and on the local economy. We estimate a statistical model, an event study model, that instruments for bank market share in the year before a large natural disaster. So the model that we're using, we're going to be able to sort of look by time, year by year, in the subsequent years following a disaster, what happens to overall credit, and what happens to overall credit to the area based on the composition of the local banking institutions, we call them, at the time of the disaster. Importantly, we're going to try to isolate the causal role of these institutions, and the way that we're doing that is trying to separate sort of lending that's sort of driven by the institutions themselves from sort of the economic environment at the time of the disaster. And so as we know, there's lots of sort of historical reasons why certain banks would expand or develop in one region rather than another, and we want to sort of isolate the role of the bank itself from, say, population or industry composition and other things that could affect both how much money is lent and how the recovery fares in the region. To do that, we're going to use state-by-state deregulation that many of you are aware of that occurred beginning sort of prominently in the early 1980s and through the mid-1990s. This is a type of sort of exogenous variation that's been used in the literature before. We find that counties with a high concentration of local banking at the time of a natural disaster have less total post-disaster credit than those that have a higher concentration of sort of the Wells Fargos. So this is actually in contrast to our earlier finding in Dan and mine work in New Orleans. Here, the results coming from a much larger set of events, but there appears to be some heterogeneity in sort of kind of what's best for a region, and at least as we expand the lens beyond sort of the right tail event, it appears to be more important to have these well-diversified national banks operating. I'm not going to show you the evidence about the sort of economic recovery today due to time reasons, but we do find some evidence that kind of lines up that those areas that, not surprisingly, have more credit provided to those areas following a disaster also have faster regional recovery as measured by higher local wages, lower or higher employment, and less population loss. So we sort of build our starting point off the literature. Broadly speaking, there's sort of three factors in the literature that we label as capacity, incentive, and information. So this capacity measure would otherwise sort of allow us to think that areas that have more sort of national banks, more non-local banks, would have a greater capacity to lend following a disaster. So these banks would perhaps be more diversified, be able to pull in asset or cash and assets raised in other areas and lend them to the disaster-stricken area. So there's some literature that shows this to be the case. At the same time, there's two sort of things that are pushing in the opposite direction that might want us to think that we should have a higher concentration of more locally focused banks in the area. The first is the incentive, what we're calling the incentive sort of mechanism. Local banks have a greater incentive to lend to a disaster region. A collateral shock to borrowers will make lending to the disaster-impacted region more costly due to higher moral hazard. Non-local banks will shift lending to regions that now have a higher expected return. And then finally, the information sort of channel, as was already brought up in the earlier comments by Governor Bowman. It's well known that more local banks have sort of certain informational advantages or soft information that they can use to better discern between sort of and make kind of better judgments on the risk related to loans in that area. So in our mind, it's really sort of a question that deserves empirical analysis because there's sort of factors that are pushing us in both directions to consider what might be best for the region. To do this, we pulled together a new database. We combined a bunch of different data from several different sources. I really won't have time to go into too much detail on all of these, but I want to at least highlight what we're using. So first, we need a measure of these regional shocks, these regional natural disasters. We're going to go to presidential disaster declaration data for these. So presidential disaster declarations are at the county level. So our unit of sort of a region is going to be a county. And we want to expand our lens beyond Hurricane Katrina, as I mentioned, sort of move down that sort of the cost curve of these disasters. In order to do that, we collected information through a Freedom of Information Act request on administrative data of where FEMA provided public assistance to repair bridges, roads, and public buildings. So we can use that as a real consistent measure of sort of where the severity of the disasters occurred. We have bank deposit information through the FDIC. This is how we construct our local banking measures. So in contrast to our previous work, we're defining a local bank or a national bank and the county when we aggregate up based on where the deposits for those institutions are from. The loans that we look at, we'd love to look at all types of loans, both home loans and loans to businesses. Unfortunately, we haven't been able to find sort of a county level, sort of comprehensive loan database to businesses that extends earlier than 1997. So our focus in the paper at this point is we're using home loans through HMDA. I already mentioned we're going to use state banking deregulation. These dates and information have been used in the literature, included the cited paper and economic information from several federal agencies. Our main sample, one thing to mention here is we're going to kind of, based on the data limitations and sort of the deregulation identification that we're using, it restricts a little bit of the time period that we can look at. So in the analysis, the results that I'm going to show you, it's going to be important to think that this is estimated off of a time period from 1990 to 2006. There's a few reasons why we chose that time period. We can get into it maybe in the discussion, but I don't want to talk about it right now. In the last few minutes, I just want to be clear on the local banking measure that we're using and then show you a couple of our key results in figures. So again, we use the FDIC bank deposits data to define a lender localness score for each lender in each county for each year. We can then calculate a county local banking index by taking a weighted average of the lender localness scores. So now we have a county sort of index or sort of proxy for the banking institutions in the county that varies by year. Closer to 1 implies that more of the lending or more of the banking in the county is done by banks that are focused and receive a lot of the deposits in the county itself, as opposed to other regions where they might have operations. Here is just a picture of kind of what this score looked like in 1995. So this picture doesn't have state boundaries on it, but for many of you, it'll be pretty easy to see the state boundaries because there's a lot of within-state correlation in this measure of local banking. That's precisely what we'd expect due to the timing of state-level deregulation. For example, up where I am in Montana, you can kind of clearly map out the border with Idaho. I'm going to show you two results. So first, here's a result for overall credit allocated to the disaster counties following one of these large natural disasters. So we can measure overall credit based on the total number of, the amount of dollars that are allocated or on the number of loans that are allocated, and they both tell a similar story. The way to look at this, again, is the vertical line in the picture is the timing of the disaster. To the right of the vertical line is sort of the years post-disaster. The dark line shows our point estimates from our statistical model, and then the colored region is the sort of the uncertainty interval, the 95% confidence interval. So what we see is there's about a 5% reduction in overall credit or overall lending in the counties that experience these large shocks in the 5 years following the disaster. So at the time when individuals may most want to use lending to sort of smooth consumption and deal with this shock, there's actually less lending available. And then how does this vary by kind of the composition of banking? This figure is a little bit hard to interpret because it comes from a model where we're interacting this banking share with the timing of the disaster. The key thing here is to look at whether it's going up or down. is going down in the picture, so it's negative. What that means in our setting is that those regions that have a higher share of sort of local banking that's done by these locally focused banks at the time of the natural disaster actually have, on average, lower amount of credit and a lower number of loans going to these areas post-disaster. I think I'm out of time. I'll leave it there. I don't want to eat up anyone else's time. Thank you.
Thank you, Justin.